Hello everyone, welcome to Search for Yields by INR Bonds. Myself Nikhil. Today I'll be discussing about how Fed's hawkish stance would impact Indian investors or savers. Before diving into the topic, let's talk about what is quantitative easing and what is quantitative tightening. The quantitative easing is a monetary tool used by central banks during the time of economic uncertainties or the lower inflation time frame. So, in quantitative easing, the central banks would set the interest rates at record lows to spur the economic activities. Or they could also go into the open market operations, that is, buying the bonds from the market and transferring the bank reserves to the financial system. By doing that, they expect the lenders to pass on the liquidity to the households or corporates, which would be used in the supporting the economic activity. When economic when the quantitative easing is announced, usually the yields tend to fall, which result in investors chasing in higher yield assets, and usually the asset prices of riskier assets starts to rise. That's exactly which we have seen in 2020. On the other hand, the quantitative tightening is exactly opposite to quantitative easing. That is, when the economies are stable and out of the economic uncertainties and everything, all the economic macro indicators start to show positivity. The central banks tend to tighten the bank rates, and also they try to suck out the excess liquidity from the system in order to keep a check on the inflation. So currently we are currently seeing that kind of a trend from the Fed. The Fed in the latest policy meeting said that they'll be raising rates as early as from March 2022, which resulted in yields moving higher. So today we have seen the USD yield at 6 week high of 1.71% and 10-year GSEC at 6.53%, which is pandemic highs. So how this quantitative tightening impacts is today's topic. So in the latest policy meeting of Fed, they said that in the minutes showed that the Fed will raise three rate hikes in this year, and also doubling the balance sheet runoff program. That is, they want to reduce the balance sheet size. Currently, the Fed's balance sheet is north of $8.5 trillion. So the last time the Fed announced the balance sheet reduction program was in 2017. Back then, the Fed balance sheet was $4 trillion, and it is a 35% of US GDP. So the Fed chair said that they're aiming and their comfortable level of the balance sheet size is 20% of GDP. Let's assume even right now the Fed is aiming for 20% of the GDP. Then the Fed has to reduce the balance sheet by $4 trillion. The current pace is expected to be at $100 billion per month. That means the Fed would take around 40 months, that is almost about 3 years, in order to shrink the balance sheet from $8.5 trillion to $4 trillion. So as a result of this news, the equities across the globe fell, and also the US yields have risen, and the domestic market yields also risen. The inflation target for the 2022 is set at 5%, which is much higher than which we have seen before pre-pandemic. This is the USD chart here. So if you see the start of the chart, the pre-pandemic, the yields were at 1.6%, and as soon as the quantitative easing have been announced, that is setting the rates at all-time lows, the yields fell sharply below 0.5%. Currently, the yields have risen sharply from the month of December after the Fed policy meet. The real rates are the rates that's difference between the current bank rate and the inflation. Since the inflation across the developed countries are much higher than what is the bank rate, that's why the real rates are negative in those countries. Let's assume that in this year, as per the Fed guidance, even if it's raising the rates by 3 times in this year, even let's assume it's raising by 0.25% in each hike, it would be the Fed rate would be in the range of 0.75% to 1% by end of 2022. The inflation target set by Fed for this year is 5%. So the real rates still would be negative for this year in developed countries, in most of the developed countries. So the investors, what would be the investors should do at the time of the yields rising, and also the real rates are negative. It's uh, it's quite suggested that investing in a shorter term bond, shorter maturity bond makes sense, because the longer term bonds will carry the high duration risk. That means if the interest rate cycle changes, the longer maturity bonds tend to have a longer tends to change. The price tends to move sharper than the shorter end maturity bonds. So if you sign up on QuickInvest platform, INR Bonds QuickInvest platform, you can filter your returns. For example, here I have set the returns from 8% to 20%, because if you fall in 30% tax bracket in India, and you're given the inflation at 6%, your break even would be around 8.57%. And the maturity I have set for under 5 years. So we have around more than 10 bonds under these filters, where you can come and obviously check with your financial advisors before investing uh, into these bonds. So by investing in the shorter term bonds, what benefits you is that, for example, if you invest in a 6 month and 1 year bond, right after the maturity, you can reinvest those money into the higher yields, since the interest rate cycle is changing. It also protects you from the higher inflation, and also, given the equity markets are very quite volatile, if you are not unsure of the timing the equities, it's suggested take a very shorter maturity bond, just say 6 months, and right after 6 months, when you get your coupon payment and your principal back, you can rethink about entering the equities, or if you wish to invest, if the interest rates are higher at that time, you can reinvest at higher yields. That's it for today's SFI. Thank you for listening in. Do check out our Quick Invest platform and experience our seamless process of investing in corporate bonds. And do subscribe to our YouTube channel if you have not done so. Thank you for listening in.